Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Kevin Romney. In 1989, Kevin founded the Romney Group, which owned and developed commercial property and managed retail, office, and medical projects. In 2019, Kevin founded the Camino Verde Group, which acquires value-add properties and manages the repositioning and asset management. They develop properties from the ground up, including the buildout of co-living properties in Southern California and the development of a community in Utah. So thank you so much for being on the show, Kevin.
Well, it's my pleasure to be here. Thank you for inviting me, Charles.
So you have a very interesting past, and I'd love to kind of learn what your background was, both professionally, personally, prior to getting involved in real estate investing.
Sure, be glad to share that with you. I got a degree in accounting. Went to work for one of the big 8 CPA firms. That kind of dates me now. It's the big 4. But learned quickly that people didn't, they didn't really like to see the auditor coming. He's just there to catch their mistakes. And so left after about 2 years, decided I wanted to be an entrepreneur and do my own thing. So I've built several different businesses, call center business, franchise business, vending business. Most recently, I was in the renewable energy space, and I'd run that company for about 4.5 years. And I was ready to make a switch. And I met with one of my good friends, Mike Ballard, who's my business partner. And he and I had originally met in college, but we reconnected when my son asked his daughter to prom. And anyway, I had breakfast with him one morning. I said, Mike, I'm thinking about selling. What am I going to do next if I sell this company? And he's a partner in a company that does the back office accounting for about 55,000 multifamily units across the country. And he said, and he had done some real estate, I'd done some real estate, but we'd never done multifamily together. So he said, why don't we form a partnership and get into the multifamily business? So I did my due diligence and got back to Mike, and I said, I'm in, let's do it. And that was February of 2019. So we're coming on just about 4 years here that we've had, that we've built the Camino Verde Group.
So when you were doing your due diligence on getting back into real estate, what were some of the points, factors that really weighed important to you in making that decision?
So a lot of the data that I reviewed and looked at showed that multifamily was one of the top sectors in the real estate industry for returns, number one. Number two, is for stability. Folks that have been in retail, for example, are going through the online issues, and people are shopping online as opposed to brick and mortar, although it's beginning to come back now at this point. But residential, you always have to have a roof over your head. And so, we just felt that was, it's probably the most, in my opinion, the most secure sector of the real estate industry is to be in residential, and multifamily is just, you can go buy a bunch of single family homes, and acquire quite the portfolio, or you can do it 30, 40, 50, or 200 or 300 units at a time through multifamily. And that just seemed to be the better route to go for us. Plus, that was the area that my partner had some expertise in. So that's the direction that we went.
Yeah, I imagine so. With doing all the back office accounting for all those units, I imagine those are all larger complexes.
Exactly.
So, Kevin, what was when you guys started investing? What was your first property? What was your first investment that you guys did? And what did you do with that? What happened? Do you still own it today?
Great question. So our first property was Sherwood Apartments here in Las Vegas, 36 units. We found that on market through a broker. We purchased it. It was in pretty good shape. The units had been refurbished and remodeled, so there wasn't a heavy lift as far as remodel goes. But we did a facelift, put some paint on it, did some redid the courtyard, and then did some minor touch-ups in the properties. And it's been a great property for us. We currently still own that property. We have tinkered with the possibility of selling it. We actually had it under contract for a time, but with the increase in the interest rates from the Fed, the credit markets have been choppy, but anyway, it's a great stabilized asset that's got a great interest rate on it, especially with today's rates. And we still own that and manage it, and it's been a great asset for us and for our investors as well.
So, Kevin, you're being based in Las Vegas. You've been at this prior to COVID, and I really haven't spoken to an operator that went through COVID in Las Vegas. And as I read online during that time, Nevada was about almost 33% unemployment rate at that point, where a lot of the places where we are in the Southeast were 12 or 13. How did you guys fare with having that hit you guys immediately in the beginning of 2020?
Great questions, Charles. We at the time that COVID hit, we closed on a property just at the height of everything shutting down. And I have to tell you, we were very nervous as to whether or not we should even continue. We thought maybe we should just walk away from this deal. We went ahead and closed on it and did the deal. That property has also turned out to be a super property for us. But I'll tell you a story. We did have, so at the time of COVID, we had 3 properties here in Las Vegas. And one of our properties, one of our major investors was just very concerned. He thought, everything was going to fall apart, and he wanted to sell. So we were able to put that up, sell it. We made our investors good money on that one. But the other 2, we continued to go and run through the pandemic. And to be honest, yes, we had 30% unemployment, but we had people moving in left and right from California and other places that wanted to take advantage of the great benefits that we have being here in Las Vegas. And so rents grew. I mean, we saw 25% increase in rents. We certainly had some challenges with delinquencies. Our properties are Class C workforce housing, but the government CHAPS money and the pandemic money was able to assist many of those people. We did have some people that took advantage of the situation, and they sat there. We had at least one person who didn't pay rent for a full year, and it wasn't until after the pandemic was over that we were finally able to get them out of the property. But anybody that would talk to us, anybody that would work with us, we were very flexible with being able to come up with a payment program or working with them to help get government funding. And really, it didn't affect us terribly. The properties fared very well. As I said, rents increased, and we were able to help most people find help. And so we didn't even really, of course, they had eviction moratorium, so we couldn't evict folks. But even after we came out of the pandemic, most of the folks continued to live with us and stay with us because we'd worked with them and worked through those issues and problems.
Yeah, the problems when I self-managed properties for years, it was when you don't have the contact, the communication, that's when you get nervous. Right. That's when you know there's an issue. It's one thing if they come to you and I got this issue, and then everything's being poured out, and you're like, okay, now we can make a deal. We'll find something that works, right? It's the thing is like when you're like, we have no idea if person's ever in this apartment anymore. We have no idea. Am I paying for electric? Are they paying for electric? What's going on over here? So I know how that goes.
Exactly right. Anybody that would talk to us, work with us, answer their door, we worked with them and helped work through the issue. But Some people just said, we're not going to, it wasn't very many, probably only one or two that just ignored us. And like you said, we didn't even know if they still lived there or not.
Yeah.
Because they wouldn't answer the door, they wouldn't answer a phone, they wouldn't answer a text, but they were there, and we're just kind of hiding out and taking advantage of the situation. But again, that was a very small portion. Most people were anxious to work with us, and we were anxious to work with them, and it turned out being not near as bad as anybody had anticipated it was going to be.
Well, good. So most real estate investors prefer off-market deals, and I know you guys do as well. And what do you consider to be some of the major advantages of doing off-market deals?
So we probably about 60% of the deals that we purchase, and we've been in business almost 4 years now. We've got 15 different projects we've been purchased or working on. So about every quarter we do a deal, and we prefer about 60% of those have been off market, and we prefer off market for a couple of reasons. Number one is there's a whole lot less competition. When you're bidding with a lot of other people and you get to best and final, and it's just when you're bidding against 10 other people, the price can accelerate, and your chances of being able to get a deal done go down dramatically. So that's item number one of why we like to do off-market deals. Another reason is that the timeline is frequently a little bit, the pace is a little bit slower. It's not the timeline's not accelerated. So we can take our time a little bit more with due diligence. We can take our time a little bit more with negotiating. And so it just generally all around, it's just a much better process if we can find a property that's off market.
When people, I think, hear the words off market, I believe they think that a buyer like you is cold calling different property owners. But obviously with larger complexes, that's not usually the case. I mean, what were some of the sources that you have utilized to find some of these off market deals that you successfully purchased?
That's a great question. So the way that we've found them is, a couple of different ways. We've gotten leads from insurance agents. Attorneys, CPAs can give you great leads. I'll tell you a fun story. Again, I mentioned my partner and his work with doing the back office accounting. A lot of his clients are property managers. Many of them are property, people who've broken off from the bigger companies that are starting their own property management company. And he had a gal that was in the Nashville area who broke away from her company, and she said, "Mike, I want to manage a property for you." And he said, "Well, okay, go find one." And she was able to find an off-market deal for us that we were able to secure. Actually, we were able to do seller finance on that property as well, and about 260 units, and it's just been a phenomenal property. So that was one source of being able to find an off-market deal, was through property management company. But the majority of our off-market deals come from brokers. In particular, if you develop those relationships with those brokers, we closed that first deal that I mentioned. And once that broker knew we could get a deal done, we became one of his preferred buyers. And so anytime he'd get something that would come in that was off market, or sometimes even pre-putting it, before putting it on the market, he'd let us take a look at those, and we've been able to buy, I think, probably 4 or 5 additional properties through him that were off market. So brokers has been the main things, but property management companies, insurance companies, CPAs, attorneys, all of those can be great sources for off market properties.
So with some of these off market deals, I imagine you've gotten, or you've spoken to these owners previously about owner financing. How have you created deals, if any, with owner financing? And how's that process go if you had, like, through a broker? Because now you're not direct to the owner, let's say.
So if we work through a broker, let me cover a couple of things about owner finance first of all. So we never come out with that being our first option. Sellers are not really excited about doing a seller finance. So we never come out with that to begin with. But as facts come available, and as we get down the road in the negotiation process and we learn certain things, we can then say, okay, this might be a candidate for owner finance. For example, the deal that we did out in the Nashville area, it's actually in Kentucky, just over the border. This particular property was managed. The individual had bought it, had paid cash for it. So that's an important thing. If you're going to do a seller finance, generally they need to own it free and clear. That's not always the case, but generally they need to own it free and clear. So he had paid cash for this. He had just finished remodeling. He had bought it for about $40,000 a unit. He wanted to sell it to us for $60,000 a unit, but he had his family managing it. And because his family was managing it, it wasn't a professional management company. He wasn't using a professional accounting software. He didn't have really good financials that he could take out to a broker and list this property with a broker. So he had a problem. He couldn't really go out and list this as a normal owner would. And so because of that, we said, well, hey, listen, and also if you don't have great financials, you can't get funding. You can't get the bank to loan any money on it. So, the option is, either owner finance or run it for another 6 to 12 months the right way and get the proper data on it. We purchased a 9-unit small motel out in Paramount, Nevada. We had a specific use for it that we were able to repurpose it and use it for residential. But that property it had been on the market for a while. There weren't a lot of uses for it. It had sat. The owners owned it free and clear. And so as we began to find this out in the negotiation stages, we were able to say, hey, are you willing to carry the note? That's generally how and the brokers will generally let you deal directly with the owner when you're negotiating that, or you just, do your offers and send it to the broker, and broker gives the owner, and you just go back and forth several different times in turns on the LOI. And that's how we've been able to do it. It's been very successful for us.
Yeah, that's good. It's great information about not coming out of the gates with owner financing. I think a lot of new investors will do that only want to do owner financing deals. And it's like, well, you build rapport and then you talk to them about it. Well, what are you doing next? And kind of feeling them out a little bit, I think, is a lot more of a effective method of getting to the end goal of owner financing potentially.
Absolutely. We have a 240-acre master plan community up in Ephraim, Utah that we've been working on, and we've accumulated a lot of land, and a lot of it has been farmland. And a lot of those deals that we've done, we've probably purchased from 10 to 12 different owners to be able to accumulate that land. Many of them were farmers, and as we began the negotiations and the talks, the question was, if you got a large sum, if you sold all this money and got a large sum of money in the door, how's that going to affect your taxes? If we were to pay this over time and you could recognize that revenue over time, would that be a better situation for you with your taxes, as opposed to having a big chunk of change come in? And they don't want to do a 1031 exchange. This is property that's been in the family for sometimes 2 generations, maybe even 3 generations, and they're ready to liquidate the land and use the funds for other things. And so you just ask a lot of questions, and for most of them, it was going to be a big tax issue if they got a big lump sum, so they were willing to let us stretch it over time and pay them over time. So that was great for us, because we had to come up with less investor dollars to be able to take down that large amount of land.
That's great. That's an awesome use of owner financing. So with going into developments, your firm purchases a lot of value add properties while also developing properties. And I think I saw it was about half your properties in your portfolio comprised of development deals. So it's definitely something that you're very strong into. Is your company focusing more on developing projects now versus acquiring projects? And why so, if that is?
Great question. We're probably about 40% acquisition, about 60% development. For a time there, prices per door were getting so high that we could build, for example, there was about a 500 unit property that sold not far from my home in Henderson, Nevada. and it was a 1990s product, and it sold for $297,000 a door.
Wow.
And my goodness, we can build this product brand new for less than that. And so that's when we began to take the shift towards development. So my partner handles more of the development side. I handle more of the value add side. But I will say that development is a lot more difficult, and there's a lot more risk with development than there is with value add. If you're buying a value add, you're buying a cash flowing property, and there's less risk. If you're doing a development, you're buying land, you've got to get it entitled. Then you've got to get your debt and all your other things and equity put together. And so the risk is higher, so the returns have to be higher for the investors as well. And there's a lot longer lead time. It may be 36 months or even longer before you get that property built, get it stabilized, and you and your investors have any cash flow and any funds coming from it. So you've got to have capital to be able to do all the architectural and get the entitlements done. So it's a lot longer road. It's hard road. There's more risk involved in development, but there can also be greater rewards. So we kind of do both here at Camino Verde Group, value add and development both.
When you are, let's say, like underwriting between development and acquiring a property, what kind of, let's just say basic, back of napkin, what kind of return premium do you want to see on that development deal versus a value add deal where it's probably cash flowing day one when you buy it?
Right. Great question, Charles. So we don't generally present anything to our investors unless we project a 15% IRR on value add.
Mm-hmm.
So if it's a value add, we want to be able to, in our underwriting, project a 15% IRR to our investors before we present it to them. On the development side, that's more. It needs to be above 20% before we present that to our investors, and we prefer to be in the mid-20s as opposed to the low 20s. Now, not every deal we do, hits the mid-20s, but if we're going to do a development deal, it's got to be able to project a 20% IRR to investors, or we aren't going to move forward with it.
Yeah, I definitely agree with that. I've just seen some development deals that get close to that 20 or even in the high teens, and it just looks like they're really stretching for a deal, and it's not something for the risk you're taking. You want more of a return on that. You know what I mean?
Exactly.
So,
yeah, investors deserve a greater return because there's a greater risk on it.
Yeah. So, Kevin, what are some common mistakes you see real estate investors make over decades of being involved with this?
So, mistakes that I see is, I think people can sometimes move too rapidly, make decisions too quickly, fail to do thorough due diligence. I also see, sometimes folks not being conservative in their underwriting. Especially, we've got these huge rent increases that we've experienced over the last 2 or 3 years, and some people are underwriting that those increases are still going to continue at higher rates. We tend to be more conservative. We know that those rent rates aren't going to increase that quickly in the future as they had in the past. So we tend to be a little bit more conservative with our rent increases. So those would be the mistakes I'd see, is not doing complete due diligence and not being as conservative as they ought to in their underwriting.
Yeah. Have people underwriting what they did 2 years ago. They're still using those rent increases in today's numbers is something you see a lot, or they're not doing the increases in insurance, for example, expenses that, hey, that's going to be going up much higher than you're expecting.
Absolutely. Insurance has gone up dramatically, hasn't it?
It's all parts of the country. I mean, I'm down here in Florida, but I mean, I've seen properties double digits in other parts of the country as well, when the policies come up. So it's just something you have to keep an eye out when you're underwriting.
Right.
So Kevin, I like when I get successful people on the show, I love asking them how their relationship towards money has changed over the years, because probably where you started out, it's probably a little different than where you are now, right?
It is. That's a great question. When you're starting a business or when you're starting out in life, cash flow is very important. I've married and have kids and now grandkids, and being able to support and fund and give them the lifestyle that you want is very important. So So I think when you're starting out, money and cash is important to be able to accomplish your goals for you and for your family. But as you grow and as your balance sheet grows and your bank account grows, that's always the primary importance is taking care of your family. But as you become more successful at what you do, I think the focus changes to how can I now help the community and help others. And so, I guess my attitude towards money and cash is now it's more, how can we use that to benefit other folks and to do good for other people? Most of the deals that we do, I'd say almost every deal that we do has some sort of social good connected with it. For example, we have one property that's got a master lease on it with a veterans organization. And, they're great tenants. And we lease it to them for less than market rate, just because it's got a social good, it's got a cause. We've got these veterans who dedicated a large portion of their lives to defending us and our freedoms, and we want to give back. And so most of our properties, we always want to make sure, look, we want to have a nice, safe place that's affordable where people feel safe. So I think now at this point in my life, it's how can we give back? How can we bless others? Where can we, what organizations and charities can we help to move society forward and make things better for all people?
That's great. What do you think are the main factors that have contributed to your success over the years, Kevin?
Great question. And I would say two things: great mentors and hard work. We have had some incredibly good mentors since we started this business. A group that we worked with out of Austin, Texas, that helped us acquire this property in the Nashville area, and mentored. And one of the gentlemen was on the phone with me every week for a couple of months, just teaching me about the business. And so, great mentors has been a wonderful thing. And because we had great mentors, we try and give back, and now we try and mentor other folks as was done for us. So mentoring is incredibly important, surrounding yourself with good people, and then you just have to work hard and not give up. It's a hard business. It's a great business. It's a great business, but it's also a hard business. So you just stay at it. And if you hit a few bumps in the road, don't give up, just keep going after it, and persistence and hard work, and it'll pay off.
Kevin, how can our listeners learn more about you and your business?
So Charles, they can go to our website, which is www.caminoverdegroup.com. And I would be delighted to get emails from anyone. My email address is kevin@caminoverdegroup.com.
Well, Kevin, thank you so much for being on the show today. Looking forward to connecting with you here sometime face-to-face in the future.
Great. Charles, thank you very much for inviting me. It's been a pleasure.
Have a great rest of your day.
All right. Thanks. You too.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.